Welcome back to Ask the Compound. I'm your host, Ben Carlson. What is the best time to invest in the stock market? Maybe during a bull market? You could buy the dip during a correction? What about a lost decade? I answer this question and more on today's show. Duncan, let's play the music. Our email here is askthecompoundshow at gmail.com. We were talking this morning about how impressive it is that each and every week we get something like, 10 to 12 questions straight from our audience every week. The questions are always really well thought out and insightful. Just a very high IQ audience here. Right, Duncan?
Yep.
On this week's show, we answer questions about, is it good or bad to start investing during a lost decade? If you ever have one of those again, should you borrow money to buy stock in your own private company? Does it ever make sense to take out an 84-month auto loan? I still can't believe that's a thing. Are retail investors propping the market up every time that it falls? What are my personal views, me, Ben Carlson, on Bitcoin as an investment? And what's the best way to automate your health like your wealth? I'm turning into a health influencer, I guess. If you're live in the chat on YouTube or Twitter, hit us up with a question and I will do it live. All right. Today's show is sponsored by our friends at Public. Public is the investing platform for people who take investing seriously. You can build a multi-asset platform of stocks, bonds, options, crypto, and more. You can also access industry-leading yields like 4.1% APY on your cash, no fees, no minimums. Public also uses AI, not just as a feature, but it's just woven into the entire experience, from portfolio insights to earning call recaps. Public gives you smarter contacts at every touch point. Plus, for a limited time, 1% match on all IRA deposits, IRA transfers, and 401k rollovers. Fund your account in 5 minutes or less. Find out more at public.com/ATC. Paid for by Public Investing. Full disclosures in the podcast description. There's a link in there somewhere. All right, let's do it.
I like the match. It sounds like free money.
Right?
1%, yeah.
Never give up on the match, right? All right, let's do it.
All right. Up first, we got, is it a good thing or a bad thing if someone started investing in that lost decade?
All right. Nice, short and sweet for you, Duncan. Travis, throw up the chart here. This is based on a question or a blog post I did. Had Chart Kid Matt create this chart for me showing annual returns by decade. Someone on Twitter asked me, well, hey, that lost decade in the 2000s obviously sticks out as the outlier here. One of these things is not like the other. Is that a good thing or a bad thing? Now, it could be a bad thing. You can do chart off. If you start investing during a lost decade and it ruins your perception of risk and scares you away from the stock market. I think it did that for a lot of people in the 2010s, that it was hard for them to get back in because they got so scared because they had this lost decade and bookended by two huge crashes. But as someone who actually did first start investing during the lost decade of the 2000s, I think my first investment came in 2005, 2006, something like that. It was perfect timing. My only regret is that I was just starting out in the world and didn't have more money to put to work. So I'd like to say that those DCA purchases I made in my 401k IRA throughout 2008 will absolutely be the best investments I've ever made or ever will make in the stock market, bar none. So let's look at a quick example using historical market data to show why investing during a lost decade is a good thing. So here's what I did for a little experiment. Let's assume you dollar cost average $500 a month, not $5,000, that'd be a lot. $500 a month for 10 years. Then after that 10-year period, you let the money ride for 10 years, okay? So I did this scenario analysis starting in 1990, which was a huge bull market that just grew and grew as the decade got along. Not many corrections, not many bear markets, which we're getting into later, just a massive bull market. I also started it in 2000, which was the start of the lost decade, right? So dollar cost averaging in during a bull market for 10 years, letting it ride for 10. Dollar cost averaging during a lost decade for 10, letting it ride for 10. Which one did better? Travis, let's do a chart on. Surprisingly, you did much better in 2000, right? So you put money in for 10 years, then let it ride for the 2010s. Put money in 10 years in the 1990s. You did much better throughout the 1990s, but as you went into that last decade, it did much worse. So, dollar cost averaging during the last decade won by a large margin because you're putting money in at higher prices in the 90s. Now, obviously, the 1990s were followed by the lost decade, but that's why this is a good illustration. If you're regularly stocking money away in the stock market, you don't want new all-time highs all the time. You should prefer volatility. You can do chart off, Travis. Those down markets give you a better entry point. So if you're young and have the stomach for it, dollar cost averaging into the market, like most normal people do, a lost decade is not something to fear. A lost decade should only be scary to investors who are fully invested, right? So net savers should pray for sustained periods of poor returns. Sets you up for better returns in the future.
I can kind of relate to this because I did this with a single stock. over the last several
Give it a
years.
lost decade in Oli.
With Oatly, I kept buying it, and is it down like 95% since it IPO'd? Yes, but I'm now up because I just kept buying it all along the way. So, not I wouldn't recommend that to other people, but I'm just saying
All right.
it's the same principle, right? It's I took advantage of it falling. Is it smart in a single stock? No.
Yeah,
Did
you're
I do it?
averaging down,
Yes,
right?
but yeah, yeah,
Yeah. Would have felt better if it was going at all-time highs all the time. But yeah,
yeah.
that sets you up for better returns in the future, assuming they come, right? That's the idea here. And I think we have a question. Someone asked if we can actually have lost decades going forward. We'll talk about that later, but let's do another one first.
Okay. Up next, we got one, and there was some foreshadowing at the beginning for anyone paying attention. But this one
That was
is
like Fight Club, where they just sneak in the little,
right. It was a subliminal
snippets.
message. Yeah.
Yeah.
My buddy works for a major private aerospace and spacecraft manufacturer that's not yet publicly traded. He was asking me about what he should do about his ISO, incentive stock option, that's coming up. His dilemma is that he's allowed to purchase up to $5,000 of shares at a price that is less than half of what the shares are trading at on the private or secondary market, but he doesn't have the cash to purchase the shares. Is there a way for him to take out a loan or something else to buy shares? The deal seems too good to pass up. I don't know anything about ISOs, but I figured you guys might have some insight on this.
Yeah, well, let's bring in someone who actually has some experience working with stock options, our resident expert, Mr.
Hey,
Joey
Joey.
Fishman, coming to us live from Ritholtz Wealth office in Bend, Oregon. All right, Joey, let's start with ISOs because we've talked about RSUs in the past. Explain what an incentive stock option is for us.
Yep. Incentive stock options are earmarked specifically for employees of a firm. And if you can follow the thread, essentially, because they're incentive stock options, they give you the opportunity to have favorable tax treatment on the way out. It sounds like it's somewhat easy to navigate, but the reality is it's really hard because there's a lot of different complicated tax treatment and time thresholds that you have to meet along the way. That being said, like if
Well,
the
like vesting
company's
periods and such, like you have to be at the company for a certain amount of time, or okay.
Precisely. So, like, it could be in this case, like, there'd be more questions I'd need to ask to answer this question with specificity. But essentially, we would need to find out, like, is this like the first of a series of vested shares that are going to be given to this particular person that works at this company, or is this like a one and done type of thing? Either way, you want to have a good sense of what the chain looks like when you start liquidating these and have a very keen sense of awareness, so that way you don't run afoul of some of the rules that would otherwise incur you to pay higher taxes on the way out. And so it's a really, really complicated subject to take apart, especially in a digestive bite in a thing like this. But what I will say is, um, even if the shares were to vest, it doesn't necessarily mean that this person's friend needs to immediately exercise the shares and pay for them. That's the first thing. The second thing is that if they
All right,
did
they
want
could
to
get them and the money comes later, right?
precisely, they can hold on to the ISOs. They have a 10-year window after being granted, or actually after vesting the ISOs, that they then have to liquidate them.
Right, because the
So
company
there's
wants to give you incentives to stick around.
Precisely. So you'd be really hard pressed to go out to like the public options market to find an option contract that has a longer expiry than like 2 or 3 years. So like this is a 10-year window for hopefully the company to put up or shut up, and ideally it gives you a long running window.
So my initial thought, personal finance wise, and I don't know how old this person is, and they kept it anonymous, but
Mhm.
um, if you don't have $5,000 in cash savings, maybe investing in private companies, 50% discount or no, is probably not for you. But let's just assume, let's assume they do have the cash from whatever source. Like
Mhm.
if they do borrow somehow, the obvious risk here is, yeah, you buy the shares at a 50% discount, but it could be worth nothing. And to your point, it could be 10 years till you get some liquidity or something. Well, let's say it's a young person, whatever they do, they take out an advance on a credit card. Someone in the chat said that take out an advance on a credit card, like $5,000. Someone will give it to you somehow. Is that a
Mhm.
good trade? Probably not. But what sources would you ever be comfortable with in terms of borrowing for something like this? Because the liquidity mismatch here is obviously the big problem. You borrow money, the company goes out of business, you still owe the borrowed money back either way.
You do. I mean, there are companies set up that will lend against your shares on a non-recourse basis. So, like, if the company blows up, you don't owe anything. At this stage, the
Duncan
way in
wants that
which
for Oatly, I think. Um,
The way that this question was framed is that the company has a secondary market right now, and that the secondary market shares are trading for an absolute premium
All
above
right, so that's
what
how they
what
know, obviously. Yeah, because a lot of these things do have prices these days. You can look on different platforms.
totally. So it sounds like there actually is a market for these shares. So like if they wanted to, they could exercise and sell simultaneously. If they do, like the spread between their strike price and the market price is going to be taxed at ordinary income. If they instead decide to just exercise the shares and pay for the taxes out of immediately selling shares to cover whatever amount that's going to be acquired for, provided to solve their tax liability, whatever remains then can sit for as long as they want.
But it sounds to me
Meaning,
like these things are complicated enough where talking to someone about your options makes a lot of sense. If maybe the company isn't providing anyone, but yeah, talking to some advisor, someone who understands this stuff, it sounds to me like that's something you want to do before you just jump in both
it
feet
is
first, you know?
super complicated, yeah. And so, again, like if they're at this stage of the game, they're probably already working with like a Carta or a ShareWorks that will, when they go in to model out various scenarios of when I sell these shares, it should specifically itemize like what the tax is owed, if there's any AMT tax liability that may come with it, and making sure the company is withholding enough on their behalf. And generally, what you want to do, just to make sure, because it's so complicated and getting it wrong can be costly, what you typically want to do is, run through Carta, run through ShareWorks, or whoever is the custodian of these shares. Then you want to recreate this, in your own spreadsheet, and if necessarily, have an AI assistant recreate it. So if those three things produce the same results, then I think you have a really good sense of, what the tax treatment's going to be on the way out. Ideally, like in this person's case, my sense is, my hope is, I should say, that they have a strike price of like 15 cents on the dollar, and hopefully this thing is trading at 30 or $40 by the time it's all
Right.
said and done.
Yeah, and that's the
Yeah.
hope, right? Why I can see
Mhm.
why they'd want to get into this. I just say, yeah,
Totally.
however you're getting the cash, be smart about it. But yeah, I don't know.
Yeah,
There's
yeah. It,
And
it,
is
it-
this always sanctioned by the company, like the selling of shares of a private company? Or are there ways people are doing this just kind of on their own without the company's involvement?
it depends. It depends. Like a lot of private companies have like a dual trigger, meaning that like the shares have to vest and there has to be a liquidity event for you to be able to sell the shares, even if there is a secondary market for it. It depends on which stage they are in the process. This kind of sounds like pre-IPO. So there's the reason why there's that large spread between what the employee can execute the share price versus what somebody on the secondary market, just goes to show like there's high demand for these shares on the secondary market, and clearly this thing is on a strong trajectory.
And then the hope would be that Robinhood tokenizes these shares so it's easier for you to trade them someday. That's that's the end goal. All right, Joey, thanks for your help as always. Go hit
Appreciate
the
it.
Thanks,
go
Joey.
hit the trails on your mountain bike. See you, man.
See ya.
Let's do another one.
Okay. Oh, one question I have for you, Ben, that you might know the answer to. I see a lot of these platforms now advertising you can invest in a private company, you can buy shares. It's like crowd, kind of like crowd investing. I've seen a couple that say like we already have a ticker reserved on fill in the blank exchange. Uh, does that mean anything? Like, can anyone just buy or go ahead and reserve a ticker, or does that mean that they really are going to be going public very soon? Or can
I've
anyone
never
just
got.
speculatively do that?
I'm sure that's a little bit of a carrot on the stick type of thing, where there's probably some time that they can do. I don't know the
I just didn't
actual
know,
IPO
how big of
process
a
and how
deal that
works.
actually is. If it's like, oh yeah, they're definitely going to go public here in the next year, or if it's just like, no, anyone could really just do that.
No, I'm sure if there was a time limit on, that would be kind of inside information a little bit because then you'd know exactly like when they have to go public. So it probably doesn't hold their feet to the fire on anything, but it makes you feel good that you can have like
It's good
a really
marketing.
cool ticker.
Yeah,
Yeah.
it's gotten my attention.
All right. Let's do another one.
Okay, question 3 is from Charlie. I know this article is a few months old, but I wanted to reach out to you to get your opinion on something. We recently purchased a Toyota Grand Highlander. I haven't heard of a Grand Highlander for our growing family. The vehicle costs basically $50,000, and we made a $20,000 down payment, leaving a loan balance of a little over $30,000. Our local credit union offered an interest rate of 4.4% for any loan term, so we decided to go with an 84-month term given the low rate. Am I making a mistake by choosing this route? The low interest rate feels like cheap debt, and while we do plan to pay off the loan much earlier, it gives us the flexibility to continue saving and investing, potentially earning returns that match or exceed the cost of the loan. It's
Listen.
crazy that 4.4% now is considered low because I think the last car that I bought years ago, a few years ago, was like 2.2% or something.
Yeah, yeah, it is. It's all relative these days, right? Because
Yeah.
going rates are like 8 to 10%. Now, if I was Dave Ramsey, I would crawl through your computer screen and grab you by the neck and say you can never take out an 84-month loan. Ever. Ever. So actually, let's put some context on this. So I did write about 84-month auto loans a few months back. Travis, throw up that blog post I wrote. I saw Ford CEO Jim Farley on CNBC, and he said, listen, customers are rational. This happens in our industry. Quality of the vehicles is up. Vehicles are lasting longer. He says in Canada, 84-month leases or loans have been a third of their business for quite some time now. He says this is just the new reality of customers adjusting their payment because they act completely rational. Chart off. So after that, that was right after the earnings call. So I went to Quarter and found the transcript. And he talked about it there too. And he said, yeah, we've been seeing 84-month increases. Travis, you can throw up the picture here of Jim Farley. I think it's Chris Farley's cousin or something, maybe. Anyway.
Wait, this is Ford CEO?
Ford CEO, yeah. He said customers are doing what they need to do to adjust their payments. And I still remember my first car loan that extended to 60 months and thinking that felt like a stretch at the time. My first ever car loan, I think, was 36 months. Travis, you can take it off. So what's going on here is car prices are up a lot. You mentioned, Duncan, borrowing rates are up a lot too. I think that, again, the prevailing rates are 7 to 10% for some people, depending on their FICO scores. So people want to keep those same monthly payments, so they're just extending their loan period. 84 months it's 7 years. So for most people, this is irrational. Most people don't drive the same vehicle for 7 years, let's be honest, even though cars are staying longer on the road.
Well, that's the thing. Cars are getting better, but they also are getting better at such a clip that, yeah, why would you want to hold a car for a really long period of time?
Yeah, right?
Now?
Because you get new technologies and more safety features. So listen, borrowing at prevailing rates for that long for a depreciating asset is nuts. However, that's not everyone. Charlie here isn't simply trying to keep the same car payment. He put a sizable down payment on, right? Put 20 grand down, 40% down payment. He got a terrific interest rate, 4.4% for any loan term is phenomenal right now. Please send me the name of this credit union because I'd like to talk to them. Credit unions are a great place to borrow to. I have my mortgage through my credit union. I think I did a car loan for them before. And plus he said they have the ability to pay it off sooner if they want to. But so this 84-month auto loan actually makes a ton of sense to me because it's a lower payment. It gives them flexibility. He said he's taking the difference and investing it. He could pay it off if he wanted to. I actually have no problem with this one. I think the way that he's thinking about it, again, big down payment. This is not like someone who's extending a loan and putting nothing down because they want to keep trading up and keeping the same, I don't know, 4.4% borrowing at 3% inflation. I don't hate it. Right? This isn't the worst thing in the world.
And when treasuries are yielding what,
Yeah.
So, yeah.
Yeah, exactly. Treasuries are yielding 4.5% or something. So I'm actually okay with this, even though for most people it doesn't make sense. In this case, context matters.
I think you'd be proud of me. The last car, my current car, I leased, which was a first for me, and I didn't put anything down. They didn't make me put anything down. I was like, I'll pay a higher payment for being able to have more money in my investment
account. Might as well, right?
Now,
at that point, right?
Yeah, that's time value money, right?
All right, let's do another one.
Okay. Up next, we got. Do you think that
unless you're Oatly is like reverse time value of money sometime? Well, all right, I gotta quit with that one. All right,
you know what? I'm at least I'm now in the green. I'm now in the green.
All right, good for you.
Okay. Up next, we got a question from Darren. Do you think that free trading platforms like Robinhood, Fidelity, Schwab, etc., and our sponsor today, Public, are helping the market avoid longer bear market periods? Or do you think that, barring a major economic crisis, a lost decade could still occur despite continuous inflows from retail investors?
All right, Sean in the chat says Oatly's a great stock to keep my mouth shut, so I'll keep that name out of my mouth. So a lot of lost decade talk today. Here's another good one from Chart Kid Matt that shows the number of days between new all-time highs. Right?
This
kind of
goes
chart,
to
right?
your thesis that the market's getting faster, right?
Yeah, the market's
getting faster.
That is I've had that thesis for a long time, and I think it's being borne out. So to be fair, 2022 was a run-of-the-mill bear market. You can see 2022 up there. It lasted, I think we had 2 years between all-time highs, 2+ years, right? But if you look at 2020 and 2025 on there, those barely even register, even though those were pretty decent downturns, right? We came back so quick. So I do think there's something to be said for the fact that the nature of recoveries and investors are conditioned to step in and buy, everything's moving faster. It's the information age, it's retail. Travis, do the next chart, please. This chart from Yahoo Finance. I think we used this before. this just shows retail investors stepping in a big way to buy the dip. Now, some people will say, well, it's all the fiscal money that's been thrown at people this decade. I don't know. I was told excess savings from the pandemic ran off like 3 years ago. I think this is a new thing. So I think this certainly has had an impact on the V-shaped nature of recoveries. So you can do chart off here.
This chart makes me proud because over the years we've seen on the Compound channel and our social media a lot of people being like, easy for you to say you got to buy stocks when they were cheap. Now everything's so expensive. It's nice to see people actually acted on it when the market dropped and bought in big time.
Yeah,
it's cool.
Yeah, people are taking advantage. So again, I'm a big believer that technology and the information age, and let's be honest, government intervention is causing these things to be more V-shaped and shallower than they were in the past, not last as long. Like we've taken off the left tail of the Great Depression, right? If the pandemic would have happened in the 1940s, the stock market probably would have fallen 80% or something, 60%. It would have been a bloodbath. The Fed and the government would have stepped in. However, these periods where you have this relative calm of not many huge downturns, this also just happens sometimes. So from the end of World War II through the end of the go-go years of the 1960s, so that's like started in 1968, we're talking 20 plus years. There wasn't a single financial crisis. There wasn't a big stock market crash. There was corrections along the way. There were bear markets, run of the mill. There were mild recessions, but there weren't any like bone-crushing crashes that leave this indelible mark on investor psyches for generations. Travis, throw that up there, this table. Also, from following that period, so you can see all these corrections and stuff, but no like really bone-crushing huge ones. And then you had the nasty 1970s, you had 2 crashes, you had high inflation, and then the early 1980s, Volcker took rates to 20%. You had a nasty recession and a pretty bad bear market to start the 80s off. But then from call it 1983 all the way through the start of the dot-com crash in early 2000, so that's almost 20 years again, no big financial crises. Right? Yeah, sure, you had this mild real estate blip in 1990. You had the 1987 crash, but let's be honest. The stock market finished up in 1987. It went off to the races immediately following that crash. So these weren't any huge crashes in terms of the time it took. And then you finally got your comeuppance in 2000. Then in 2008, you got it big time again. So you have these periods of time where you can go 10, 15, 20 plus years without having a huge financial crisis. Chart off, please. The point here is, though, you get those lost decades because of the deep recessions and the financial crises, right? The 1930s, the 1970s, the 2000s, periods littered with banking crises, deep recessions, policy errors, right? So retail investors and automated investing have certainly helped when it comes to the length of corrections. I kind of believe that corrections will be more short-term in nature going forward. We might just have more of them. But we haven't had a real recession in 15 plus years. The one in COVID doesn't really count because we threw so much money at it. People were unemployed and they were making more money. That doesn't count. It lasted like a month. So a financial crisis situation to hold their ball game, like we need to see something like that to really put this theory to the test. I would not completely rule out lost decades going forward. We'll have a financial crisis again at some point. Maybe it's in the coming years. Maybe it's not for a decade or two. But human nature more or less guarantees the existence of financial crises. Will that lead to a lost decade? I don't know, but we can't test this theory without running through a financial crisis, which could happen, I don't know. Maybe when all the baby boomers die out in like 2055 or something. Then we'll have a financial crisis. I don't know. But it's going to happen again.
I kind of enjoy the fact that retail has figured out, and I'm talking about like Wall Street bets, people especially, but they figured out that you can use things like short interest against the big players in the market. And they're just doing it relentlessly. You see all these stocks that are like the most shorted stocks in the market, and they'll just have like weeks where they go up 60%.
Josh was saying this yesterday in a Slack channel with me and Michael, like, what are these hedge funds doing if there's 50% short interest in a stock? Like, why would you leave yourself exposed to that? It's, yeah, you're right. The retail is smarter money in some days, that they're taking advantage of these things that they know will happen.
Right. Yeah, because some of these stocks are just incredibly, like you're saying, shorted to such a degree where you'd think someone would start to get nervous at a hedge fund or, some of these big players. I know that they're good at what they do and it probably usually works in their favor, but I'm just saying once you see a crazy amount of short interest and you know that this is now the play.
Yeah, why would you stick around? Cliff in the chat mentioned Kohl's. I thought Kohl's just had a really good AI strategy. I thought they were going to like tokenize Kohl's cash maybe. Is that their strategy? But no, it's just short interest.
Yeah.
All right, let's do another one.
All right, up next we got a question from Matt. With Bitcoin hitting all-time highs, I want to know how Ben approaches crypto and how he views it as a percentage of one's total investment portfolio. Does he have any exposure personally, and how does that impact conversations he has with clients?
Full transparency here on Ask the Compound. People are asking me personal questions all the time. Where do I get my clothes from? These types of things. Where's Duncan get his hats from? How does he groom his beard? I don't have any hard and fast rules when it comes to Bitcoin. When I first bought it, I think early 2017 was when I first bought it, and I've slowly but surely built up a position over time since then. I told myself it was a buy and hold forever kind of asset. And that was back in the days when people said, listen, only put enough in where if it goes to zero, you won't blow yourself up and you won't be that mad. So that's what people were saying. I wrote a blog post about this at the time. I think it was in, I don't know, November, December, when Bitcoin first hit $100,000. I lightened up my position and I said, I'm going to be a little more smart about rebalancing this because it's had these huge crashes in the past. And it got to such a big position for my portfolio that I decided it's too much for my blood. Now it's real money. So, and I think that's actually one of the benefits of such a volatile asset is that you can rebalance. Now, maybe I'll regret that decision if it keeps moving higher and it goes to like 200,000. But crypto is still a higher percentage of my overall net worth than I ever would have expected when I first started investing. I think I looked this morning just to check. It's like 8 or 9% of my investable assets. It's way bigger than I ever would have thought.
Yeah, when you were doing the CFA, how much did they advise?
Crypto didn't exist. I think the Bitcoin white paper was written right after I finished my CFA. Now that's about clients. Like we do have a way for clients to access Bitcoin if they desire, and we've had plenty of those conversations over the years. We don't like force it on people, but some people come to us already owning crypto and have made money there. Some people want to have it be part of their portfolio and not just all on their reports and their screens and have it there. Some people still want nothing to do with it, and that's fine too. So we just wanted to have an option for people on exposure, and we've got one of those in a reasonable way through one of our custodians. I actually don't have a lot of strongly held views on Bitcoin. I've probably said some stuff over the years that I regret, but I think a lot of people have. People who are in the Bitcoin sphere and people outside of it. Because I don't think any of it has worked out how anyone thought it possibly would. I mean, when it first started, people thought it was going to be a currency. You were going to buy stuff with it. That obviously didn't happen. People thought you were going to tokenize everything. Maybe we still will. I think
I remember selling like most of my crypto after it doubling back in, I don't know, 2018 or something, 2019.
I give the people who have held the whole time, I give them credit. They're either like the most steady-handed investors ever. They're psychopaths, but you have to be like a certain kind of person to hold through that kind of volatility of these multiple 70 and 80% crashes.
I'm back in now, but at a much higher cost basis.
I think digital gold is probably still my base case, although it's obviously a much more volatile asset. So I'm fairly certain it'll crash in the future, especially if we have another recession. But I wonder if it's more like 40 to 50% crashes now that it's more institutionalized in an ETF versus 70, 80% crashes of the past. Maybe I'll be wrong about that, but that, again, I don't have a ton of strong views, but I'm at the point now where I've turned it into a portfolio management thing where I'll be like rebalancing around it when it hits certain thresholds. That's the way that I view it now. So I've managed to turn Bitcoin boring in my portfolio, which I guess fits my personality, right? I'm kidding.
No, I mean the ETF is a game changer for sure. That's just so easy. It's made it a lot easier, and it just feels safer to a lot of people that aren't like super.
Well, and the spreads are much lower too. You trade on any of these other platforms, and you get these really wide spreads still. You do it in an ETF, you don't have to worry about that. Yeah, you pay a fee, but I think it's probably still cheaper than if you would have had, just buying it through an exchange.
When I was talking to Compound viewers in the What Are Your Thoughts chat yesterday about this, like I have stuff on Coinbase and I'm like, why do these tokens take, weeks to unstake? Like, I don't understand. It's some of that stuff I find interesting, but it's also kind of complicated. Whereas with the ETF, you're buying and maybe you're missing out on some features like staking, but yeah, it's just easy.
In the chat, they're saying Ben's not boring. Look at his shirt. That's fair.
It's true.
I'm overcompensating. All right, we got one more question.
Okay. I feel like you really love this question. This one's from Alec. I always hear people say that physical health has a lot of similarities to financial health because both take discipline and deferred gratification. The disconnect for me is that I have all my financials and investing automated, so I can't even be tempted to stray each month. How would you recommend setting up guardrails or keeping yourself disciplined when it comes to your physical health?
Yeah, I'm dipping the toe in the waters of being a health influencer.
I like it.
This looks like a plant question to me because I'm in total agreement here. I've written about this before. I've talked about it before. The personal finance trope has always been, listen, your health and your wealth are very similar. You know exactly what to do, but some people just can't follow it. They can't force themselves to follow it. But With investing, it's way easier to automate your wealth than it is your health. You can automate your contributions, you can automate your asset allocation, your rebalancing schedule, dividend reinvestment, increases your savings rate, you can automate your bill pay. You can take your, I have everything automated too. You can completely take yourself out of the equation in a lot of ways. And you can even, again, have it like automatically increase how much you save each year. So just you take yourself completely, you can set it and forget it. You can't really automate your health. You have to force yourself to work out every day. You have to make endless choices about food intake. I think the number I heard, and there's a book called Mindless Eating that's really good. It's like you're forced to like hundreds and hundreds of food decisions every day just from looking at stuff in your pantry or at the store. So there is no set it and forget it when it comes to your health. So I equate health and wealth more to compounding and the fact that little gains over the short run can compound into big gains in the long run. So I think I started lifting weights regularly at 16 years old because I was playing football and I was like a buck 20, 5'0" in high school, coming into high school, and I needed to get bigger, otherwise I was going to get killed out there.
Same. I lifted so much in high school.
Yeah, I bet you were a big bench guy. I think I've been jogging 3 to 4 times a week since my early 20s. I know some people hate working out, but I'm one of those mutants that gets the endorphins or whatever it is where I don't feel good until I get out of my system. Schwarzenegger was on Smartless last year, and he said he rides his bike to Gold's Gym every day, which is kind of funny that he still goes to the gym. And he said when he rides his bike, it's gray, like a black and white movie. And when he comes out of the gym, it's like color. And I get that feeling too. I know some people just hate it with all their being, but for me, I feel better after working out.
I feel that way after a good run, as long as the weather's not like 95 degrees.
Yeah. See, I don't mind running when it's really hot out because you sweat a lot. But yeah, it's not very comfortable. The much harder part for me was changing my diet because working out was always easy for me because I played a bunch of sports in high school. But I always ate like crap because when you're young, you have a higher metabolism and you're working out so much, it doesn't really matter. I didn't really change that until I had kids and realized that I needed to be healthier to have more energy. Because it's like when you get older, you have like a quarter pounder from McDonald's and you feel like you need to take a nap. That was an old Kevin James bit where he's like laying down in McDonald's, like, "Sir, what are you doing?" He said, "I just had a Big Mac. I need to lay down." And so I do have some thoughts on ways to like automate your health process, even though it's not as easy as automating your finances. So like simple things like laying out your workout clothes or packing your gym the night before kind of holds yourself accountable. It's just staring at you the next day. I think you put your workout time into your calendar. I do this sometimes, right? I'm blocking out my calendar from 12 to 1. I'm going for a run. So I think you have to plan it out in advance. Mondays and Tuesdays are for lifting or swimming. Tuesday, Thursdays are for cardio and walking, whatever it is. Like you, right? What does Ron Burgundy say? Tuesdays and Thursdays are for back and buys. I think for your diet, it's really boring. But you basically, if you want to eat healthy, you have to eat the same thing over and over again. That's the simplest way to be healthy. It's boring, but it works. Like these are the 3 to 4 meals I will eat for lunch every week. These are the 3 to 4 meals I'll eat for dinner. Then you give yourself a cheat meal or a cheat day or a cheat weekend or a treat, whatever it is, because no one has enough self-control to be good all the time. And you need something to look forward to, right? Just like your sidecar with your portfolio, right? I'm trading options and investing in penny stocks, whatever it is. But I'm over here, I'm dollar cost averaging. And for working out, I would say you try to keep it fun by joining rec leagues and such, but I think that can be dangerous as you approach middle age. Michael still plays in some basketball rec league. He's going to blow out his MCL or his Achilles at some point. I've had so many stories from friends. And when you're old, when you're young, you can recover from that pretty quick. When you're old and you're in a walking boot and you have kids to take care of and you have a life, like you can't be doing that at middle age. I'm sorry.
You have to like miss work because you broke your arm playing pickleball.
Yeah, right? Yes, you know that stuff happens. Pickleball probably doesn't have as many injuries. They just hit each other with the rackets, though. My most recent way to keep exercise fun for me is with my kids. Shooting baskets in the driveway, football in the backyard. My oldest daughter doesn't have a lot of meat in her bones. She's kind of skinny. And the girls in West Michigan can be big, like, right? There's a lot of farming communities around here. So she's playing basketball and soccer. These girls are big, so she wanted to get stronger. So we just decided to do body weight stuff for her. So this summer we've been doing push-ups and sit-ups and squats and lunges and these sorts of things 2 or 3 times a week. And then my
just
two
pounding
youngest
protein shakes.
Yeah, we're working on it. We're trying to, and my 2 youngest join in sometimes because they don't want to miss out. And then once a week we have a soccer field down the street from our house. We go run sprints and we bring our dog, and of course the dog's the fastest one. But my kids are so competitive that they race each other, and so that I do sprints with them too, which I probably could pull a hammy there too. But I think much like investing, successful, healthy outcomes are usually boring. So eating the same boring meals over and over again, doing the same boring exercises over and over again. But I think boring in the short run can be beautiful in the long run, right?
Yeah, and I think like investing, I think the fact that you're even thinking about this, going back to
Yeah.
Alec, like that's a good thing. You're already ahead of the game because the average American is definitely not doing well from a nutritional and diet and health standpoint. The standard American diet literally spells sad. And that's a joke people often make. Like so, just the fact that you're thinking about this and being cognizant of it probably is putting you ahead of the game. And yeah, I mean, I think that diversity, you're saying eat the same thing, but like making sure that you're getting a diversity of things. They say like eat the rainbow, like these things are important. Making sure you're getting all kinds of stuff in your diet is
Yeah,
good for
and
you.
you find what works for you. There's a million different things you could do. My biggest thing is just figure out a way to sweat a few times a week, whatever it is. It's walking, jogging, lifting weights. Someone here says that this is a good one, that they go to the gym that has childcare, right? And it says
That's smart.
they charge you for canceling your childcare appointments. That's a good one. So your kids are taken care of, something for them to do while you work out. We actually have one of those gyms around here too.
Do you use anything like a chronometer app or anything like that to track
No, I don't
your
track my
exercise and
sleep.
diet?
I don't count anything. I just try to be reasonably healthy.
I do it like once a week or so, like just to kind of like make sure I'm, my diet's tracking along well, I'm getting everything I need. But yeah, I don't do it religiously.
Yeah, that kind of stuff would make it not very fun for me. Counting calories or counting, what do they call it for keto? I don't even know. I don't count any of that stuff, but I just try to be reasonable. And yeah, I don't care what my sleep score says or whatever. I feel like optimizing that much is almost more problem than it's worth. Like you start getting anxious about it if it doesn't show exactly what you want.
Right.
All right. My new fitness app will be called, I don't know.
You know what we should do? We should do a virtual run. We should do an Ask the Compound run for like charity. That'd be fun.
All right. Well, everyone will put on their Apple iPhone things on their face.
Yeah.
Macros, that's a keto thing. There you go, Sean.
Sure.
I don't count anything. All right. Thank you for everyone tuning in live. As always, the chat was bumping today. askthecompoundshow@gmail.com if you have a question for us. Again, every week we get dozens of questions. It's great. Sorry if we can't get to some of them. We'll get to them in the future. Make sure you subscribe, rate, review. New Compound and Friends on Friday.
Yep. It's a
See you
good
next
one.
time.
And over 2,000 people watching today. So thanks to all of you, wherever you're watching.
Thanks,
Appreciate
everyone.
it.